Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about the Estée Lauder Companies Inc. quarterly report. The Estée Lauder Companies Inc. offers a wide range of products and services to cater to various beauty needs. At the core of its offerings are skincare products, including moisturizers, serums, cleansers, toners, eye care, body care, exfoliators, acne care, facial masks, and sun care products. In addition to skincare, the company provides a vast array of makeup products such as foundations, powders, concealers, lipsticks, mascaras, eyeshadows, and compacts. It also offers fragrance products in various forms like parfum, eau de toilette, eau de cologne, body spray, lotions, creams, powders, candles, and soaps. The company's hair care portfolio includes shampoos, conditioners, styling products, treatment, finishing sprays, and hair color products. Furthermore, it sells ancillary products and services through various channels such as department stores, duty-free retailers, specialty multi-retailers, online pure players, upscale perfumeries, pharmacies, top-tier salons, spas, freestanding stores, brand websites, and third-party online platforms. The company operates under numerous brands including La Mer, Jo Malone London, Tom Ford, Aurion Beauty, Le Labo, additions to Parfum Frédéric Malle, KLA in Paris, BLMA in Beauty, Estée Lauder, Clinique, MSC, The Ordinary, Aveda, Bobbi Brown Cosmetics, Too Faced, Dr. Jart Plus, Bumble & Bumble, Smashbox, Darphin Paris, Lab Series, NIOD, Aramis, and GLAMGLOW. The significant increase in Estée Lauder Companies Inc.'s stock price can be attributed to several key factors that contributed to a strong positive sentiment and performance over the past year. One major factor was the company's successful turnaround efforts, led by CEO Stéphane de la Faverie, which included cost-cutting measures, layoffs, and strategic steps to become more agile. The Beauty Reimagined plan, aimed at improving the cost structure, fueling growth, and delivering sustainable long-term value, was seen as effective in driving positive momentum. The company's improved financial performance and outlook were also significant contributors to the stock price increase. Estée Lauder reported strong second-quarter results for fiscal year 2026, with sales up 5.6% year-on-year and adjusted earnings per share beating analyst estimates. The company's strategic investments and market share gains in key regions such as the Americas, mainland China, and Japan also played a crucial role in driving growth. Additionally, Estée Lauder's focus on prioritizing consumer-facing investments to fuel growth, along with strong organic sales growth and product innovation, contributed to the stock price increase. The company's ability to generate increased cash flow from operations was another significant factor, with net cash flows provided by operating activities significantly increasing to $785 million in the 6 months ended December 31, 2025. Overall, these factors combined to drive a 139% increase in Estée Lauder Companies Inc.'s stock price over the past year, making it one of the top performers in the market. The Estée Lauder Companies Inc. market capitalization of $35 billion is significantly larger than the average industry peer of roughly $1 billion. This shows that the Estée Lauder Companies Inc. holds a significant advantage in their industry. The Estée Lauder Companies Inc. trades at a higher price-to-book ratio of 8.68 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The company exhibits a very high leverage profile, with liabilities accounting for 81% of total assets. This elevated debt level warrants heightened caution, as it may limit the company's financial flexibility and increase risk during economic stress. We have to further examine the industry and the nature of the business to determine if they justify the current valuation. Liabilities have increased, while assets and equity have failed to keep pace or declined. This suggests the business is not growing and may be in decline, making it a highly unattractive investment from a risk perspective. Shareholder equity has weakened over the past 5 years, accompanied by declining or negative operating income. This suggests the business may be eroding shareholder value and warrants caution. The share count has increased while revenue and shareholder equity are declining. This indicates that management has not yet proven the business model is sustainable. This makes the investment case highly unfavorable. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and his management is unable to expand the business. The primary drivers of revenue growth or decline can be identified through an analysis of the provided summary. Revenue growth is primarily driven by several factors across different product categories and geographic regions. In the skincare segment, volume increase, pricing increase, and favorable foreign currency translation contributed to a 4% and 2% growth in Q3 and Hone, respectively. The fragrance segment also experienced growth due to higher net sales from Tom Ford and Le Labo, as well as favorable foreign currency translation. Mainland China and priority emerging markets within the Americas and EUKEM also showed significant growth. On the other hand, revenue decline was observed in the makeup segment due to pricing decrease and a decrease in net sales from Estée Lauder, Bobbi Brown, and Too Faced. Hair care also experienced a decline due to Aveda's planned reductions in online promotional activity and exit from underperforming doors. Other drivers of revenue growth include an increase in net sales, lower expenses within non-consumer-facing areas of the business, and favorable foreign currency translation. However, goodwill and other intangible asset impairment charges had a negative impact on revenue. The net income and profit margins of a company underwent significant changes in 2025 compared to 2024. In terms of net income, the 3 months ended December 31, 2025, saw an increase of 100% from -$590 million to $162 million. Similarly, the 6 months ended December 31, 2025, experienced a 100% increase from -$746 million to $209 million. The profit margins also showed improvement. The gross profit margin remained relatively stable at 76.6% for the 3 months and 75.3% for the 6 months in 2025, compared to 76.2% and 74.8% respectively in 2024. However, the operating profit margin saw a substantial increase from -14.5% to 9.6% for the 3 months, and from -9.5% to 7.4% for the 6 months. The significant improvement in net income and profit margins can be attributed to the restructuring program initiatives implemented by the company. These initiatives aim to simplify processes, outsource select services, and evolve the go-to-market footprint, which is expected to yield annual target gross benefits of between $800 million and $1,000 million before taxes. The company's financial performance suggests a strong ability to generate cash from its core operations. According to the extracted summaries, the company is expected to produce a significant amount of operating cash flow in 2025, with 2 separate sources confirming this trend. Firstly, on page 69, it is stated that the company will have an operating cash flow of $1,271 million in 2025, indicating a positive operating cash flow. Secondly, on page 71, it is confirmed that the net cash flow provided by operating activities for 2025 is $785 million, further solidifying the notion that the company is generating positive operating cash flow. This trend suggests that the company's operations are profitable and capable of producing a substantial amount of cash, which can be used to fund future growth initiatives or pay off debt. The company's debt level has undergone significant changes over the past year. Initially, long-term debt increased by a mere $5 from $7,314 to $7,319 on page 3. However, this increase is overshadowed by the substantial growth in current and total debt levels. The current debt level rose by 5.6% from $4,004 million to $4,229 million on page 30, while the total debt increased dramatically by 421% from -$701 million to $570 million on page 69. In terms of interest expenses, there is a notable decrease in net interest expense and interest expense. On page 1, the company's net interest expense decreased from $182 million in 2024 to $171 million in 2025. Similarly, on page 62, it is reported that interest expense decreased by $11 million in both the 3 months and 6 months ended December 31, 2025, compared to the same periods in 2024. These decreases indicate a reduction in the company's interest expenses over the past year. The performance of various segments and regions in the market has been analyzed. In terms of segments, skincare, makeup, fragrance, and hair care have shown strong performances. These segments have consistently demonstrated growth and success across multiple pages. On the other hand, no segments are explicitly mentioned as performing poorly. However, it is worth noting that certain regions have struggled. The Americas and Hong Kong SAR have been identified as underperforming regions. In contrast, mainland China, EUKEM, and Asia/Pacific have shown impressive growth and success across multiple pages. These regions have consistently demonstrated strong performance and are likely to continue driving market growth. Management is anticipating a challenging business environment due to various headwinds, including volatility in Western Europe, mainland China, and Asia travel retail business, as well as department store challenges in the U.S. Despite these challenges, the company remains committed to its long-term strategy of growing sales, providing cost efficiencies, and leveraging strengths such as creativity and innovation. The Beauty Reimagined strategic vision aims to accelerate consumer coverage, create transformative innovation, and boost consumer-facing investments. A key component of this strategy is the Profit Recovery and Growth Plan, PRGP, which focuses on rebuilding profit margins in fiscal years 2025 and 2026. The company also plans to implement strategic price actions to drive growth. In terms of specific initiatives, management is planning to develop new products, address business challenges, launch successful advertising and merchandising programs, and achieve cost savings through restructuring and other charges. The company's skincare operating income has already shown significant improvement, increasing 48% for the 3 months and 52% for the 6 months ended December 31, 2025. Overall, management is focused on navigating the current challenges while implementing its long-term strategy to drive growth and profitability. The company has a history of paying out dividends to its shareholders. In the recent financial period, the total amount of dividends paid was substantial, with $4 million paid in the 3 months ended December 31, 2025, and a significantly higher amount of $257 million paid in the 6 months ended on the same date. This indicates that the company has been committed to rewarding its shareholders through dividend payments. Concerns about inventory buildup and supply chain disruption have been raised in recent times. One area of concern is the accumulation of excess inventory, which has increased from $2,074 million to $1,895 million over a certain period. This buildup is not only a financial burden, but also affects the overall efficiency of operations. Furthermore, there are concerns about supply chain disruptions, which can have far-reaching consequences on business operations. Shipment delays and disruptions at manufacturing facilities or distribution centers have been identified as key challenges in this regard. These issues can lead to reduced productivity, increased costs, and ultimately, a negative impact on the bottom line. That concludes the financial summary for the Estée Lauder Companies Inc. Feel free to comment below, and I will be happy to answer them when possible.